How much money should you put into dividend stocks? How much money should you put into growth stocks? What is the perfect balance between dividend and growth stocks? I wish there was a simple guide to answer all of these questions when I first started investing 8 years ago. So welcome back to another episode of Investing for Complete Beginners. I'm Joyee Yang, a 27-year-old finance girly who makes investing in personal finance simple and realistic so that you and your friends can take action today and get one step closer to your financial goals. If you're new to this channel, you can see my investing portfolio for free on the Blossom app, including how much dividends my portfolio is making. In this video, I want to walk you through the main differences between dividend stocks and growth stocks. I will share my personal investing strategy to balance my investments between dividend and growth, and what ETFs and stocks I plan to buy for long-term growth while maintaining dividends. Main differences between dividend stocks and growth stocks, my investing strategy to balance between dividend and growth, what ETFs and stocks I have in my watch list. You know the drill. Get your notebooks ready and give me a like on this video if you appreciate realistic investing tutorials. Beginner investors, this one's for you. I will give you the quick and easy investing 101, then we get into the good part. So dividend stocks versus growth stocks. Let me make this super clear first. Dividends are what a company pays you just for buying and holding their stock. So dividend stocks pay you while you hold them, and that cash is called a dividend. Some stocks pay dividends monthly, some do quarterly, meaning every 3 months, or biannually, meaning twice a year. And there are so many stocks that do not pay dividends at all, such as Tesla. The price growth of a dividend stock is usually slower, but for the people who prefer it, they invest in it for the steady dividend income. From my experience, the stable dividend stocks that pay me well are usually banks, utilities, and consumer goods. These are the more boring but reliable companies that are financially stable. On my Blossom portfolio right now, you can see TD Bank, Enbridge, Fortis, which are all great examples of steady dividend stocks. On the other hand, growth stocks usually don't pay you dividends because the companies keep their profits to grow the business even more. And even if they do pay a dividend, they're usually relatively low compared to stocks like Enbridge and TD Bank. When you're investing in growth stocks like Nvidia, Tesla, and Apple, you're betting the share price will be worth much more later. More upside also comes with more short-term volatility, which means that the stock prices fluctuate a lot every single day. That's why it's very important to invest for the long term, especially with growth stocks, meaning if you're buying it, you don't plan to sell for the next 5 years. So that's it for a quick investing 101. Now we can move on to what you guys truly care about. Which one is better, dividend or growth? The quick answer is if you prefer stability, put more of your money into dividend stocks so that your net worth does not fluctuate too much and you get a predictable cash flow. Now, if you're willing to take on more risk because you want higher return of investment, allocate more into growth stocks. So it really depends on what you want to achieve, which means every investor has their own perfect balance. No one can tell you that your dividend stocks are too slow or you're being too aggressive with buying tech companies. You should be responsible for how you want to balance between dividend and growth. If you're ready for my personal investing strategies and recommendations of what to buy or dividend versus growth, pay attention now. First, please comment the word balance if you agree with what I just explained so that I know you have been following my explanation. Remember, you are the person who can take action and you will decide how your money works for you. Going into 2026, I definitely want to maintain a percentage allocation to income stocks and ETFs, but a new investing goal that I want to focus on is to increase my growth allocation. Of course, artificial intelligence is a big reason for me to consider, but hear me out. I'm thinking more strategically than just going all in on AI. I've been a conservative investor for most of my 20s. You can see in my current portfolio on Blossom. I've been holding mainly banks, utilities, and broader market diversified ETFs such as VFV and ZEQT, stable growth, strong dividends, very Joyee Yang. That's how most of you guys found me, and I'm grateful to have an opportunity to speak to many of you in person and in my one-on-one calls. So going into the end of 2025 and into 2026, I still want to invest some money in income stocks, but I'm also ready to lean more into growth using my RRSP account. My TFSA will be the foundation that continues to pay me and keeps me calm, and here's my reasoning for that. I personally believe, and it's my opinion, so don't come for me in the comments, the rules for the TFSA is that you can withdraw the money at any time for whatever reason without paying any taxes. So I see the TFSA as a shorter term investing account than an RRSP. I can withdraw from my TFSA in 3 to 4 years to buy something. But RRSPs, on the other hand, it's for retirement. So I know I will not be withdrawing money from that for another 20 to 30 years, which means my risk appetite for growth stocks can increase. Now, I'm planning to start building my RRSP more actively using the money that I invest for my retirement. By the way, retiring does not mean chilling at home. It just means one has the financial freedom to no longer work for money. You can still keep yourself busy with things that you're passionate about. So, to plan for a hopefully earlier retirement, I want to take more growth risk in the next 5 to 10 years investing in the AI industry. AI is really not just a buzzword or short-term hype anymore. On the Blossom Investor Tour, I took a Waymo for the first time in my life. If you don't know, it's like an Uber with no driver. The trip was smooth, and my friends and I really enjoyed the private space while traveling on the road. I believe this is only the beginning because there will be more AI models that are actually useful, such as accounting and tax filing AI, autonomous self-driving, and maybe even cleaning robots that look less creepy. Even if you believe that there's a bubble right now or the tech stocks are overvalued, I still believe that the leading companies that build and power AI are here to stay for many more years because there are still many real-life problems that can be solved with better AI. The longevity is in our favor when we invest. Remember that you can always dollar cost average into blue chip stocks that are very likely going to stay for a long time. If you think Nvidia stock is too overpriced now, you can always DCA instead of buying Nvidia with all of your money right now. So to summarize my first investing strategy going into the new year, I'm increasing my allocation to blue chip growth stocks that benefit from AI. I just recently purchased $7,000 worth of Meta when they dropped 10% after earnings. And it dropped 10% because of a one-time accounting thing, and they're investing heavily into AI. I'm also bullish on Nvidia, Apple, Google, Amazon, which are all in the AIQ ETF that I'm already currently holding in my RRSP. Remember, I'm not sharing how to trade, we're investing here. So ignore the unnecessary noise in the news, focus on dollar cost averaging into the companies that have products that everyone is using. If you still don't know how to set up automations to help you DCA into your favorite ETF or stocks, comment DCA and I'll send you a free step-by-step DCA tutorial. The second investing strategy I'm implementing going into 2026 is to invest in emerging markets. Basically, these are countries whose economies are still developing, like India, China, Brazil, or Indonesia, and they're growing. Investing in emerging markets means you're betting on that growth. They can be and are riskier than developed markets like US or Canada, but they also come with higher potential returns. Most of my investments are based in North America right now. They are diversified in terms of industry, but I want to diversify even more into emerging economies in other regions. But you guys know that I'd rather choose an ETF over individual stocks, especially in this case. Investing in emerging markets means that I have to put my money in companies that are still relatively small in market cap. Their market caps will be significantly smaller than the blue chip stocks in Canada and the US. So my strategy is simple. I'm going to look into emerging market ETFs. One that I have my eye on right now is VEE, which is the Vanguard FTSE Emerging Markets All Cap Index ETF. This ETF is diversified into China, Taiwan, South Africa, UAE, etc. By buying just one ETF, I can diversify across thousands of companies in those countries. If you don't have time or the knowledge required to research individual stocks in those markets, like me, let the fund managers do the work for you. Vanguard is also the company that issues our favorite ETF, VFE, so they have the track record in updating their ETF holdings actively to maximize growth in the long run. Again, if I do decide that this is the ETF that I'm going to purchase, it'll be in my RSP where it has years and years to grow. If you guys are curious and want to know, again, you guys can see all the stocks I currently own and get notified whenever I buy or sell stocks on Blossom. The link to download is in the description below. Finally, my third investing strategy going into 2026 will be actively monitoring my existing dividend stock portfolio and rebalancing when necessary. I'll be putting additional money into AI stocks, growth ETFs, and income ETFs, but I still have to make sure that the money in my TFSA is working for me efficiently. So rebalancing is another key area of investing. It's very important, but it can also be made simple, the Joyee Yang way. Rebalancing your portfolio means adjusting your investments so they stay aligned with your original plan. Essentially, you're selling some of what has grown and buying more of what hasn't. For a very, very simplified example, let's say your portfolio is 50% in stock A and 50% in stock B, both companies you really like. If stock A grows and now makes up 60% of your portfolio while stock B drops to 40, you sell a bit of stock A and use that money to buy more of stock B. This allows the golden rule of investing. Buy low and sell high, selling what's gone up in value and buying more of what is temporarily down. If you guys are interested in learning how I rebalance my portfolio, like this video and let me know in the comments if I should make a video about portfolio rebalancing. I hope you have a better understanding of what dividend and growth stocks are, and most importantly, you know how to take action today to make your money work for you according to your preferences. You can click this video over here to learn everything you need to know about the tax-free savings account, which is the first investing account that you should maximize as a beginner investor. See you in the next video.